What did those jobs numbers tell you about where we are in the economy and particularly managing inflation?
Look, the economy is pretty strong right now. The question is, inflation is way above any concept of target. My view has been that inflation's not going to come down to target levels or close to target levels without introducing some real slack into the economy, which means a period of very high turbulence. Whether that slack's going to come because the Fed's going to have to push interest rates very high, or whether that slack's going to come because of internal forces in the economy, inflation eroding people's incomes and so forth, that's less clear to me. But I don't think there's a path to a low inflation economy without a material period of economic slack. It could happen, but it's not the dominant probability. What we saw today was a lot of strength, and that suggests more need for interest rate hikes, and that's what was discounted into the market.
So, Steve, you're a smart investor, so speak for the smart investors. Should smart investors be actually rooting for weaker jobs numbers than what we saw this week?
Well, just to follow on Larry's point, I think his point is completely correct. But I think if you take the probability of higher interest rates being required, given today's job numbers, and obviously that was the market reaction, I think the market is way underpricing the likelihood of future interest rate hikes. It's looking at something like 7 more hikes, and that's probably some fraction of what would be required in order to get inflation down by using higher interest rates. So I don't know what whether Jamie Dimon was referring more to the real economy or more to the markets, but I would be very worried about the markets and somewhat worried about the real economy for the reasons Larry said.
Larry, are we seeing any indications yet of a slowdown in the economy that obviously the Fed has to want if they're going to get their arms around inflation?
We're seeing a little bit of indications that some firms are no longer reporting the kind of huge labor shortages that they were before. We're seeing some indications of inventory buildups, but I think overall the picture is still a very stretched economy. You know, the statistic I like to focus on goes to the labor market, and it's the ratio of vacancies to unemployment. Typically, for every 10 unemployed people, we have 6 or 7 vacancies. Right now, we have 20. The highest we've ever had before was 15. So even if there is some easing up, we've got very, very tight labor markets, and I don't think there's likely to be substantial disinflation while we have very tight labor markets.
Steve, you'll remember that Chair Powell earlier, when we weren't seeing the inflation yet, said if it comes, we've got the tools to deal with it. I wonder whether we do. We talked to Larry Fink this week, actually, and he has his own doubts. This is part of what Larry had to say.
I don't believe the Federal Reserve has the policy or the tools to do much with it right now. And I'm personally not blaming the Federal Reserve for where we are right now. But I believe most of the problems we're living with today are more policy generated and supply generated.
Steve, what he's talking about there in terms of policy generated are things like some of our trade policies, some of our policies on immigration, where we're not getting as many workers, indeed energy policy. He's saying that's bigger than just a single fiscal stimulus package. And so that's not something the Fed can deal with. Are we concerned they don't have the tools they need to get the job done?
I would be a little concerned, but for slightly different reasons. I think some of those policy issues are certainly legitimate, but I don't think the question, for example, of immigration is really what's driving our inflationary situation at the moment, or really would make that much of a material difference in any near or medium term scenario. I think, in fairness to those who are on team transitory, there are some supply shocks going on in the world. If you look, for example, at the price of chicken and eggs, I just happen to see this, they're both up by more than double digits this year. I don't think people are eating a lot more chicken and eggs or eggs. So I think you have to look for other reasons for some of this stuff. And obviously energy was tight. We can talk more about energy, but Ukraine certainly has exacerbated that. But on the other side of the ledger, I just want to make one comment in relation to what Larry said. For those people who basically look at people like Larry and me and say, you guys keep talking about recession, what recession? There is still more than $2 trillion of excess savings or cash on the sidelines. So Jason Furman has done these numbers, and by his math, even with the lower savings rate that we've seen in the last couple of months, it maybe has brought that $2.5 trillion down by 100 million or something like that. So there's still a huge amount of excess cash. If you saw first quarter bank earnings reports, the CEOs and the CFOs are all talking about how much cash people still have in their bank accounts. So yes, I do see trouble down the road, but I don't think it's right in front of us at this moment. And then one very last point I'd make is that as we talk to companies, there is a transmission mechanism from the Fed through the capital markets to companies going on, where companies, especially growth companies, are bracing themselves for it to be harder to raise capital. And you're starting to see them cut back on expansion plans, on hiring plans, on things like that. I don't think you can find that in the numbers yet, but it's some anecdotal evidence that we've started to see.
So, Larry, what about that point specifically? Because I've had some people from Wall Street say, when it comes to really quantitative tightening, which we're seeing for the first time this week, that actually it really depends on where that money is coming out of. It's not clear whether that will slow the economy down or not.
I think that we are seeing some beginnings of the evidence of monetary policy working. I don't really understand Larry Fink's views. It seems to me pretty clear that a substantial part of the inflation we have is related to the fact that we have driven demand to extremely high levels. In 2021, GDP in dollars grew at over 11%. That's a reflection of what was happening with fiscal and monetary policy. When you have growth at 11% in total spending, you're going to have high and rising inflation, and that's what we got. So it is substantially related to what, at least with the benefit of hindsight, were policy errors in 2021. I think it's also important to understand that if your bathtub overflows, there's going to be more flooding some places than there are going to be other places. That doesn't mean that the fundamental cause of the problem isn't an overflow. And we had a fundamental overflow, and it manifested itself more in some parts of the economy, in some sectors than in others, and we call those bottleneck sectors. But in many of the bottleneck sectors, we were producing more at the end of 2021 than we were at the beginning of 2021, which is what shows you that it was kind of a demand shock. I don't think we have the tools to bring this down smoothly. The experience is, as I've said on this show before, that when unemployment's below 4 and inflation's above 4, recession comes within the next 2 years. And my best guess would be that's what we will see this time round. Yes, we have had supply shocks. There's also this idea that if it's a supply shock, we're not supposed to adjust policy. Well, I would disagree with that. If the economy is going to be kept in balance and there's going to be inflation, then if the capacity of the economy to produce has been reduced, we've got to reduce the level of demand. And this is why I always go back to the labor market, because the labor market isn't one specific sector. It's everything from child psychiatrists to workers at McDonald's, where we've allowed demand to exceed supply, creating the wage inflation, which is the basis for much of the inflation that we're seeing. So I think that we're in quite difficult situation. I don't think we had to be in this situation, and I think the Fed's going to do its very best to navigate a path, but there may not be any path of monetary policy that enables inflation to come down to the 2-3% range, and also keeps the economy growing rapidly. We can agree that that's what we all want, but that doesn't make it something that's feasible.